Hi, I'm Larry Gaines from PowerCycleTrading.com. In this short video, I'm going to show you what we call a probability trade. And this is a trade that we set up today at PowerCycle Trading on SPX, the CBOE S&P 500. So basically what I look for is this is a weekly chart, which I call kind of long-term. Now, using our indicators, these are extended range bands. So a normal range band is like from the mean moving average, like the 21, is kind of what we use for the kind of the mean reversion potential. And so this is like 2 ATR from that and 3. Now, when we get to the 3 ATR, that's very, very stretched and extreme. And now we had a cycle reversal. You can see down here crossing that yellow line, we have the arrow. So this is a weekly cycle reversal, long-term cycle reversal. And it's a really good alert indicator to identify when you get to that point where you start getting buy-in exhaustion. Now, once you get buy-in exhaustion, that can lead to reversals. So that's what we got here, the first signal here today. And you can see the last time we had something like this was back here at the end of July, and you can see it had a major mean reversion. So it went from like a little over 4,600 all the way down to that 20-period moving average, which is coming in about 45 or 44.50. So with this kind of trade setup, the first thing we look at, this is kind of a counter trend short. We look to set up a bear call credit spread to kind of initiate the trade. Now, what the advantage of that is that if the market, it could just go sideways. And if it goes sideways, that's fine because we've sold premium and we're receiving it's decaying each and every day. So it's a kind of a positive theta trade. So here's the trade setup that we did, a bear call credit spread on SPX. So went out to the 1 March series, expiration series, and that's about 17 days out from today. And then set up the trade selling the 50-70 short strike and then buying the 50-70 above. So sold this short strike here, and then to cap the risk, if in case it goes up, we bought the 50-75. Now this was the 50-70 short strike. That was about a 22 delta, about a 20 to 22 delta. So what that is telling us is that, when you look at trade probability, one way to look at it is, the delta of 1 is equivalent to like 100, right? So if you sold a short strike of a delta 22, that's showing you that the probability for this thing to be below this short strike 50-70 has about a 78% probability to be below that short strike at expiration. Or the other way to look at it is that it only has about a 22% probability for it to be at 50-70 at expiration. So doing that, you start out with kind of a theoretical 78% chance of winning, and so it's a high probability trade, and these are done for a credit. So with this trade, what we did was we went out, sold the 50-70, and bought the 50-75, received $1 credit, or $100 credit. So the risk then, the max potential profit would be the premium received of 100, $5 wide spread. So we've got a risk of 400, so it's a negative risk ratio, but that's a 25% return if this was to expire under 50-70 at expiration, which has a theoretical probability of 78. So what we'll typically do is, since we've got $100 credit, when it gets, maybe it gets to 70, 80% of that credit, we'll cover the trade. So just kind of wanted to point this out. This is kind of one of the first kind of trade setups that we'll look at when we start getting these kind of reversals. And then if we get more momentum, we can be more aggressive to the downside. So I hope this helps. Make sure to check out my next videos. Good luck trading.